Hello to you all and welcome to another video tutorial. You are with Trendy from Currency Academy, and today we are not just talking about video tutorials, but we are looking at a Forex trading webinar. So I'll be teaching you guys Forex basics, technical analysis, as well as fundamental analysis. So Currency Academy or Currency Articles is still the same company. However, we've rebranded this year to Currency Academy. Still the same company, still the same customer satisfaction as always. Okay, and a little surprise for you guys today. Today we have the So You Think You Can Trade contest. So it's a Forex traders contest, and to be in it, all you have to do is visit www.currency-articles.com and go to the competition tab for details. So the contest launches on the 1st of February this year, 2017, and ends on the 16th of April, 2017. Prize is $1,000 split amongst 4 winners. Visit the website for more details. Like us on Facebook for more details as to when the competition starts and as to your heads up and anything you may need. Okay, it's competition time, guys, and we want to reward you. Okay, so one thing about Forex trading that I want you guys to understand is the basics. So we'll be talking about the basics. Number one, what is Forex? Okay, number one, Forex stands for foreign exchange. Okay, it is the buying and selling of currencies. For example, I am traveling from South Africa because I'm here in South Africa and I'm traveling to Germany, for example. So I go to the currency table in Germany where I land at the airport and I exchange my rands for euros. So for each rand that I have to convert that into euros. And vice versa, if somebody's traveling from Germany to South Africa, they have to exchange their euros for rands. It's that simple. Okay, so that's basically what Forex trading is. So what we actually trading on the platforms and the brokers trading platforms are currencies. Of course, we are trading currencies, and this is how we make a profit. Okay, we exchanging currencies over the table. So you're not limited to currencies. There's a whole lot of other products which you can trade, which we'll also go into in this webinar. Okay, so we're talking about currency pairs, and when we're talking about currency pairs, we start off with the major pairs. Okay, so major pairs, as you would have noticed, the US dollar is highlighted in red. So this is your euro, your Japanese yen, Great British pound, Swiss franc, Canadian dollar, Australian dollar, as well as the New Zealand dollar. Canadian dollar, Australian dollar, and the New Zealand dollar are your exceptions. There's an ongoing debate whether those should be commodity currencies or major pairs, okay? But we'll agree to disagree. Either way, these are developed economies already, and they are already paired with the US dollar, which we see them as fit for being major pairs. Apart from major pairs, we also move on to what we call cross currency pairs. Cross currency pairs are major pairs without the US dollar. Okay, as you can see, the first one, we have the euro to the Great British pound, we have the euro to the Swiss franc, euro, Canadian dollar. The list really goes on, but if you're actually looking at what we're seeing here, are two major pairs, but the US dollar is not involved, and this is how cross currency pairs come into being. They pair two major pairs together. And then apart from that, we also have what we call exotic currency pairs. This one is the last on the list. These are the pairs that have the highest spread and the lowest trading volume, just because they are from emerging economies. Okay, for example, these are pairs with developing economies. Swiss franc and the Hungarian forint. Okay, we have the Czech koruna. If you guys are from Czech Republic, that is your currency. The Mexican peso. Okay, and the Great British pound and the Israel shekel. So the list really goes on. The South African rand is also considered an exotic currency. Okay, so these are emerging currencies, okay? Not from Dominica. You think exotic, you think Miami or whatever. No, with Forex trading, we are talking about a developing economy. So next on our list is what we call the currency pairs. Okay, so as you've noticed, the currency pairs are paired, okay, together. There's one currency and another currency, okay? So the first currency on your left, which you always see, is referred to as the base currency, okay? This represents how much of the counter currency is needed for you to get one unit of the base currency. Okay, so for example, one US dollar could be the equivalent of 14.5 rands. Okay, how much of the counter do you need to have? $1. So how many rands equal to $1? 14.5. This is how you read your charts using the base and the counter currencies. Okay, so the second, it's the first currency in a currency pair. Actually, there was a typing error there. It is the first currency in a currency pair. Next, we have the counter currency. Now, this currency is used as reference. Okay, so how much of the US dollar is needed to have so many rands? That could be your question. Okay, you need one US dollar to have 14.5 rands. Now, this one truly is the second currency in a currency pair. Okay, so this is your currency pairs, your base and counter currency pairs. So people always want to know when we're trading, how do we make our profits exactly? Okay, we are actually trading the rate differential. Okay, so the rate differential is to say, for example, one US dollar to, for example, the Japanese yen is 102.3, for example. Okay, so the US dollar moves up from 102.3 against the Japanese yen to 102.6. So therefore, the base currency appreciated. Okay, this is when we buy. We are buying the rate differential. Okay, so one currency appreciates against another, and if you trade in the direction of that appreciating currency, then you make a profit. Okay, so in one example is the base currency appreciates. For this example, it's the US dollar appreciating against the Japanese yen. What happens? You make a profit because the US dollar, the base currency, appreciated. Another example is when we sell. Now, when we sell, we are actually selling because the base currency is losing value. Okay, so the Japanese yen appreciates against the base currency. So instead of the US dollar Japanese yen exchange rate moving from 102.3, it moves down to 101.8, for example. Okay, so this is how you make your profits. You buy the base currency when it appreciates, you sell the base currency when it depreciates. Okay, the currency pair. Now we're looking at losses as well. Okay, it's very exciting to talk about all the profits that people can make as forex traders, but forex trading is risky. Okay, so how do we make a loss? We make a loss when you bought when you should have sold. In other words, you buy one currency and that currency loses value. Okay, so what happens to that currency? It loses value and your trade also loses value. So you are making a loss while someone else is making a profit, the one who predicted in the correct direction. Another example to look at it is when you sold when you should have bought. In this example, the base currency appreciates and you actually sold. Instead of selling, you should have bought actually. Okay, this is how you make your losses. And we'll be moving on to the next thing on our list as well.